Hello everyone, welcome. I'm here today to talk about the most important dynamic, macro dynamic, that we think that playing out right now in the markets. This is the reality. We are in a place in time and space when secular cycles impact the cyclical realities, meaning that we are in the first phase of the long-term debt cycle. I know everyone likes to talk about these big macro pictures which never seem to materialize. Well, at some point they will. The preparation takes a lot of time. The accumulation of debt takes 40, 50, 60, 70, 100 years, right? But when the process is in place, the manifestation takes only years. And this is what is essentially happening right now in the developed markets as we speak. So I want to talk about rates and where rates are right now, where they're going, and how they are impacting currencies, credit, and stocks, and crypto as well. Because this is the most important dynamic that has impact on everything that you can trade in macro space. Okay, let's start with the US rates and European rates and what is going on right now. We've 2 weeks ago we have received a print of GDP quarter over quarter, which has reaccelerated from 1.8 to 2.4, and we all know that the GDP is C plus I plus G plus X minus M, and one of the interesting things that we can take from this GDP print, which once again reaccelerated from 1.8 to 2.4, which surprised the market. The consensus was, if I'm not mistaken, around the consensus was 1.8, but the actual number came out at 2.4, and it is a big reacceleration. It's a rather big surprise for the markets, but we all know that the American economy is the consumer-based economy. And this C part usually plays the biggest role in the GDP calculations. And this time, I don't remember the exact numbers, but if you look on a percentage basis, this C right here amounted only to 40% of the total GDP number. It is an incredibly low number. But how the hell did GDP grew to 2.4% when the consumer has shrinked? When the biggest component, usually the biggest component, has shrinked. This one, government spending. Government spending and deficits increased, and they will continue to increase, especially if they do not institute yield curve control, and the interest expense will continue to rise as it does. And when we'll go forward, I will explain that it will inevitably until something breaks it, then we'll get a meaningful shift in the post-dollar system. But this is the reality. Government spending has offset and increased GDP. We are waiting for the recession. We have inflation, which is right now peaked at 9.1 and reaccelerated slightly, just so slightly, from 3% to this reacceleration that we received the previous Thursday to 3.2%. Absolute nothingness. Well, we can say, you can argue that it's nothing. 3.2% reacceleration, okay, but the rate of change is meaningful. The projection of the Federal Reserve is this one. They expect steady, slow decline. We have 3.2, and I would argue in August, on the September 13th, we'll get a print that will show another reacceleration in inflation. So essentially, this model of Federal Reserve we can change into this one, even if we get just this little bit of this of tail. There are two possible options that can get us out of this sticky situation. Either we get a recession and deflation that accompanies this recession, or we will get the yield curve control. If we don't get recession and we don't quell the inflation, rates will continue to rise, and they will force to provide liquidity, or they will force to change the law and force the institutions and pension funds institutions to buy the government debt, which is essentially the change in the fundamental change in the system that it is as it is structured right now. Let's look at the first option, recession. Everybody has been waiting for the recession at the beginning of this year, for the recession to happen in the first quarter of this year. Now everybody is waiting for the recession to most likely manifest in the fourth quarter of this year, maybe in the first quarter of this year, maybe in the second quarter. Well, you might have any projections that you want. You can look at any leading indicators, yield curve inversions. But what we have now is incredibly expanding government deficits, and it's true, we do not have the central bank put at the moment. The central bank acts in opposition to the market. But what we do have, the first time in a long time, since the last financial repression that happened in 1945, when they were first forced to institute yield curve control, we have government intervention at a very high level, and we have government put. Central bank put is gone, and central banks are largely impotent. As the Russell Napier points out, we do have government puts, and with this, we will not get a recession, and not severe enough to get the inflation under control. That's why if they stick, even if inflation reaccelerates and continue to reaccelerate on September 13th, and in their September meeting they come out and continue to pursue their opportunistic disinflation, meaning their idea right now is they raise rates to 5.5, and they will continue to hold them for a prolonged period of time. No cuts, guys, no cuts. This will not manifest the recession. This will not force the economy into a recession and solve this problem. This will not push yields lower at the long end. It's just not going to happen. They will have to engage in deliberate disinflation, meaning the only way they push yields lower if they come out and they recognize the problem and they go 50 basis points, 75 again, 100 basis points. We get a deliberate disinflation when they raise rates to the level until it chokes the economy and destroys the aggregate demand. Is it going to change the fundamental picture? No. They will force the economy into severe recession. This will force even more government spending, fiscal stimulus. This will force more inflation, more stimulus checks, and we will have the same problem all over again, because they will have to re-stimulate again, because the system will simply cave in under its own weight. This is one of the options. The other option is cap yields. That's it. We have this environment where inflation on the rate of change basis reaccelerates ever so slightly, or stays at the level at 3%, maybe a little bit above 3%. Yields, with this new issuance coming up of longer dated bonds, with the deficits, incredible deficits, which will continue to rise as the yields are rising, and yields will continue to rise until we get a recession, and we shall see on September meeting. But the problem for the US, and we've never seen this puzzle before, where Germany can institute yield curve control to some degree. Japan can do this. France can do this, and will probably be forced to do this anyway. But what about the treasury market? What about the linchpin of the whole world financial system, the reserve asset of the world? We've never had a currency and some sovereign debt to be the reserve asset of the world. Usually it's always been gold, but now we have treasuries. What will happen if they come out and explicitly say that they are capping yields at some level? They will have to soak up all of the treasuries, all of the supply. And the only one who has the balance sheet large enough to do this is the Federal Reserve. This will be pure debasement of the currency. This will be absolutely horrible for the dollar. And this is where we go in one way or another. The other thing they can do is force the private sector, force the institutions, force the pension funds to buy government bonds and cap yields on the margin like this. This is also the structural change in the system. So, however it might play out, it's negative for the dollar. But it's the question of the timing. Rates are rising on the long end in the US, and we will continue to get this bear steepener. But it largely depends on the September meeting. If they come out and recognize this problem and they will try to re-accelerate their tightening, this might actually change the dynamic once again. The 2-year yield will go higher, and the 10-year and 30-year will recognize that we have the massive meaningful change in policy once again, which might cause a recession. And 10-year yield, even if they come out and say they're going to raise by 50, by 75, by 100, 10-year and 30-year will go down, and the 2-year yield will go up. So we will get the continuation of what we had for 1.5 years. But if they don't, then the 10-year yield will continue to go higher, and the 2-year yield will continue to stay in place, and we will get this bear steepener. Same thing is in Europe. Look at the 10-year in Europe. This is something that is going to lead to 3.5% rates in Germany. Same thing in France. This is a continuation. This is absolutely a continuation. The long end is going higher. The deficits will continue to expand, and this is the vicious cycle that you cannot stop until you have to sacrifice your currency. That's the only way. You have to cap the yields one way or another. You have to either austerity, couple of ways. Austerity, not going to happen anywhere in the world. It's not going to happen. Austerity is not going to happen. Hyperinflation, probably not going to happen. Financial repression, the most likely scenario. That's it. Or default. Default is not going to happen. The most likely scenario is financial repression. This is France. This is UK government bonds. Higher. Everything is higher. Everything is going higher. And the question is, who will be forced to institute yield curve control to engage in financial recession first? Then it will play a massive role in playing the currency market, because if, let's say, Japan goes first, well, they are already in some version of it. Let's say Europe, if France in Europe goes first, then euro is going to die, essentially. Euro is going to shift into bearish trend to the dollar. They will engage in debasement of the currency. If the US goes first, then the dollar is going to die. And I would argue the dollar is going to take a much larger hit than any other currency, because how much they relied on external financing, because of the fact that the treasury is the reserve asset of the world. This is going to have an outsized impact on the dollar. It's going to be, I have no idea how it's going to happen. This is the first time there was never in history anything like this before. Well, when we had the currency as a reserve asset, as a treasury, as a sovereign debt instrument, as a reserve asset of the world. Okay, so what is the play right here? What I'm trying to point out: long 10-year and long 30-year. The easiest way to make money is to get long of 10-year and to get long of 30-year yields. How are we doing this? Essentially via TLT. Nothing, incredibly simple. Puts, sell calls, finance your puts by selling calls. You can do this type of strategy. You can sell puts directly. You can buy verticals, anything to express your directional bet. And our directional bets is yields higher, significantly higher, and TLT lower. The value of the debt is lower. The higher yields push dollar higher. Therefore, dollar is experiencing relative strength right now. It is incredibly interesting whether dollar will be able to break its trend resistance, whether euro is going to break its trend support, and everything points out to the fact that we are going to test euro. Euro is going to test its trend support right here, the first time since the shift into the positive territory, which happened on 26th of October when dollar broke its trend. We're going to test this, and this will define a lot of things, honestly. And this, we will get an idea whether this will happen probably on the September meeting, because it's very interesting whether they will reaccelerate or they will, well, essentially stay their hand and force the market to push yields higher and just force their hand afterwards. Short USD JPY, continue to be short USD JPY, and continue to be short USD CNH. That's as clear as it gets right here. The question is, who goes in financial repression first? And this dynamic of rising long-term yields negatively impacts American stock market and European stock market as well, because it sucks up the liquidity. The liquidity that could have gone into the stock market goes into the treasuries. That's why we are neutral to bearish on the SPY. We do not think that we will get something of a 2008. We're not going to get anything like this. We are in a range, in a more volatile range that we used to. This is the trend level. The closer we get to the trend level, we most likely will take some longs from here. But ultimately, the direction of the stock market depends on what the Federal Reserve is going to do. If they're going to reaccelerate their tightening, which I don't think they will, but if they do, the SPY will get probably will shift into negative territory and will drop down again. If they not, then yields are going to continue to rise, which is not going to be positive for SPY, and so we are range bound from here. And if they institute yield curve control, and the question is how they're going to do this. If Federal Reserve will provide infinite amount of liquidity and will soak up all of the bond issuance, then SPY will probably do this. But at the same time, while dollar is doing this, so the ultimate performance will be not as good, because the currency will absolutely take a hit. We will get essentially the debasement of the currency. Very interesting times, very, very hard things to predict. We are in this do or die moment, in culmination of uncertainty, and how this is going to play out is a little bit unclear for us, but we understand the ramifications, we understand the options which exist right now. And the most clear trade, once again, is continue to be long of rates, continue to short TLT, continue to be short of government debt. We believe 10-year can reach 4.95%, and 30-year can reach same levels, 4.8, 4.9%. So yeah, this is the reality. Let's see what the central banks are going to do. But the impact is clear, neutral to negative on equities. This in turn has, so far, it still has a relatively positive impact on the dollar. But if we get disorderly rise in rates, this will get negative for the dollar. We'll get the situation where rates are rising and the currency is falling. This is the worst case scenario. We're not there yet, but this is possible. This strength in dollar is probably makes the PBOC unwilling to stimulate the economy as they should, to stimulate the consumption in their own economy, domestic economy. That's why if we're not getting we've been highlighting the similar setup for a long time. If we're not getting the stimulus in the China, there is no Chinese demand, and Chinese demand impacts commodities very much so. We're not getting this long-awaited commodity super cycle. It's not going to happen until China does something. And probably, if I were the PBOC governor, I would wait for a weaker dollar to engage in stimulus, because if they engage in stimulus right now, the all out, hands on deck stimulus packages that they did in 2008, the currency will absolutely plummet. USD CNH will go up to 8, 9, 10. It's going to be very hard for them. They are waiting for the weaker dollar. That's why consolidation, neutral to negative on copper. There is no super cycle it's not going to begin now. Copper is signaling very straight, nothing to see here. That's why until we get a resolution, the race will continue to push higher and higher in Europe, in America, and until we get a natural resolution to this. Once again, it's either central banks wake up and start absolutely destroying economies, or we get some sort of a yield curve control. We're not going to get meaningful moves in commodities, meaningful moves in crypto, meaningful moves in currencies, meaningful moves in stocks as well. So right now, the most obvious play is to short sovereign debt, short European sovereign debt, long rates in Europe, 10-30 year, and long 10-30 year rates in the US. But short on the short end of the curve, we believe there's absolutely nothing to do here. There is a possibility that in the future we'll get a chance to play this on a short side, but not now. Absolutely not now. We believe the 2-year will go higher, will retest 5.5. We believe 2-year at some point will retest 5.5 in the next 2 months. So that's that. And the 10-year, we've already spoken about 10-year. So this is the most important macro dynamic right now in the whole world, which impacts the value of the currency, which impacts the value of money, overall impacts every single asset class. And the Ross Napier is largely correct, but we are not there yet. We are simply not yet into the financial repression. We are entering the first stages. Let's see how this is going to play out, what the timing is, and everything. When this comes, if they do the yield curve control to some degree, if they break the back of economy and absolutely kill the aggregate demand, this will generate a recession, which once again they will have to stimulate. They will have to engage in monetary policy, positive monetary policy, positive fiscal policy. This will re-accelerate the same cycle. This will push yields again higher, and we will be back in the same place, but with worse position. So fortunately, this long-term debt cycle is here, and there's nothing we can do about this. There's nothing they can do about this. The only thing left, if this history is any guide, is financial repression. But once again, this variable, which we've never seen before, when we have the reserve currency of the world with its sovereign debt as the reserve currency, reserve asset of the world, how this is going to impact the things is incredibly unclear. We've never had this thing happen before. This will definitely lead to geopolitical issues and problems worldwide. Let's see. And the time frame, I believe this is all going to happen in the next half a year. We're definitely going to see rates rise to 4.9 and 5% in the next half, let's say 2 quarters. And after that, okay, let's see. Let's see what will happen. And after that, it's easy what will happen. If nothing will happen, if we're not going to go into the recession, rates are rising higher. This pushes deficits higher. The deficits forcing the treasuries to issue more bonds to pay up on the deficits, essentially creating more supply of bonds, which pushes yield higher, which pushes new issuance higher, which pushes yields higher, and wait, where are we going? 6, 7, 8, 9, 10, 15%? And this pushes real yields higher. And with real yields at positive 1.7% and at this point, and which are likely to go higher, how the hell is this positive for stock market? At this point, no. Until we get resolution to this issue, it's not going to be positive for stock market. But the stock market is, once again, neutral to negative. When we get resolution, we'll get an idea, but I do not think, and I believe this was the ultimate low of this cycle, depending on whether Federal Reserve is going to do what they're going to do. If they're going to come out and raise by another 75, 100 basis points, yes, we may revisit. We may see something like 2008, but which will force them to intervene. They will intervene much faster, like they did right here, and we will get some sort of a recession like this. We'll get some sort of this move, intervention, and higher on more provision and more liquidity. But once again, rate stocks higher, dollar lower, debasement of the currency, not lower against the other currencies, but lower against gold, lower against commodities, lower essential debasement. It depends. Once again, who is going to go in financial repression first? Euro, as Russell Napier highlights, Japan, and if they go in financial repression, they will force their private sector and institutions to buy their government debt. If they will force their government to buy government debt, they will be forced to sell something. What do they sell? They are the biggest creditor right now. They hold trillions of dollars in foreign bonds and foreign equities, mostly US. They're going to sell all that to buy their own, to finance themselves. How the hell is this positive for equities, American equities? Therefore, American equities is in a very peculiar situation. Do not expect something like this to happen in the next couple of years in equity terms. No. Well, it may happen only if we get an infinite provision of liquidity, but once again, you have your SPY rise by 50% while your currency falls down by 50%, maybe even more. Do not expect the repeat of the previous decade. It's going to be much more volatile and it's going to be much more unclear. So the solution that Chris Cold provided with his Dragon portfolio, some sort of implementation of Dragon portfolio, is very handy in this time and place that we find ourselves right now. And this is it. Just to sum up, long the rates in whatever way you like, whatever way is possible. And that's it. No, there's nothing else to do, honestly. And long USD CNH and long USD JPY, they will continue to get negative price action. Okay, essentially this is everything I wanted to highlight. When the time comes, when the hard decisions, when we will be in the culmination of this uncertainty, in the moment where we will have to decide and react to the government policies, this will be interesting, but it's not now. Okay, thank you for your time.